Welcome back to part 2 of analyzing a balance sheet like Warren Buffett. If you haven't watched part 1 already, please go back and watch that now, or else this video isn't going to make much sense because it is a continuation of the first video. Again, my name is Nelson Alvarez. I'm a CPA and executive management consultant. Here in the C-suite, my mission is simple: to put you in the C-suite. Now, I know your time is valuable, so let's keep this discussion moving on how to analyze a balance sheet just like Warren Buffett. Continuing on down the balance sheet, the next line item up for discussion in the assets section is the vendor non-trade receivables of Apple. This account is a little unusual to see. Not every company has it, but what's going on in vendor non-trade receivables is that Apple actually makes loans sometimes to its vendors to allow them to operate their business, as well as also that Apple is buying some supplies, maybe some products from the vendor that are not related to Apple's core operations. Now again, typically it is an unusual account to see because for the most part, companies in general are so focused on their own operations that they could care less about what their supplier's doing or how they're staying afloat, okay? So that's why it's very important to note that Apple has close relationships with its suppliers so it can really maintain integrity in its supply chain. Okay, continuing on down the balance sheet again, we're gonna look at other current assets section. This account really doesn't tell you much about a business, so Warren doesn't spend too much time on it. Again, unless it's an outrageous amount, you probably don't really need to spend a lot of time looking through it and analyzing it. Okay, now that we've gone through the current assets section on the balance sheet, we're gonna look at the first ratio that Warren uses, and that's called the current ratio. The current ratio is a company's current assets divided by its current liabilities. This ratio, if above 1, indicates that the company could, in the event of some immediate business failure, that it could pay off all its business debts because its assets exceed its current liabilities. Okay, the current assets exceed the current liabilities. So if it's above 1, that's a good sign. Now, Apple's current ratio is healthily above 1, okay? We're gonna take its current assets of $143 billion and divide it by the current liabilities of $105 billion, okay? So it's a good number. Interesting note, okay? You can have a current ratio below 1 where your current liabilities actually exceed your current assets, but you can still be a very good business that's actually self-financing. Now, how is that possible? How can you have less current assets than liabilities, but still be a cash-generating machine? Well, successful self-financing companies tend to do a few things first. First, once a company becomes a self-sufficient, self-financing, cash-generating machine, it will typically pay off its long-term debt first, okay? And then the short-term debt. After paying off its long-term and then short-term debt, the company is then going to start buying back its stock in the market or issuing dividends. Now, doing all these things requires cash, and the company is using its cash to pay off loans and buy back stock, okay? So that actually sucks cash out of the business. So for a time, it can seem like your cash goes down, your current assets are going down, but your current liabilities are stable. So it's technically possible that your current ratio can be below 1, but you're still a self-generating cash machine, okay? So make sure you check that. Make sure you understand what the business is actually doing with its cash, okay? Because you don't want to be misled by a low current ratio number. And again, you're going to understand what a business is doing with its cash through the cash flow statement, which we will review together in another video, so stay tuned for that. Continuing down the balance sheet, let's now look at PP&E, or what they call property, plant, and equipment. Now, PP&E, as you probably could guess, includes factories, equipment, machinery, even software, okay? These types of assets play a key role in the generation of net income, okay? The assets in PPE help essentially produce our product or service, okay? So they are important. Now, what does Warren want to actually see when it comes to the level of PP&E in a company? What Warren wants to see is very little PP&E balances actually as compared to competition and as compared to net income. Now, PP&E actually tends to suck a lot of cash out of the business. They're some of the biggest cash expenditures, okay? And if you're a company that has a large PP&E balance, that means you're constantly buying the latest and greatest equipment, okay? You're updating it, you're modernizing your factories, facilities, software, okay? Through this, Warren sees it as a big risk. And it makes sense that he sees it as a big risk as well, okay? Because if I have to keep updating my equipment every single year, it indicates a highly stressful and competitive business environment. Now, it's okay to have PP&E, every single company has it, but Warren just wants to see very little of it as compared to net income. I'll discuss more in a second. Now again, what's the risk with a large PP&E balance? Why doesn't Warren like it very much? Okay, the risk is if I buy a $100 million piece of equipment because I think it'll be the latest and greatest, but then the next year something better comes out, okay, I've essentially just wasted $100 million in that machinery I bought is basically defunct and a competitor is now going to buy the latest and greatest, which puts me at a disadvantage, okay? That's the risk with PP&E. You always got to keep updating, and there's a constant risk you're going to slip up and waste money. This is why Warren tends to shy away from industries that are capitally intensive. Capitally intensive industries suck cash out of your business, all right? Now remember, what is Warren really looking for in a business when he invests in it? Cash generation. All he cares about is, can the business generate cash continually, all right? With that cash, he wants to see companies paying down debt and buying back stock, okay? That indicates he's going to get a return on investment. He doesn't like seeing companies that keep buying and buying the latest and greatest equipment, okay? Because he realizes he's not going to get a great return on his investment. Now, given every company needs some form of PP&E, what does Warren actually like to see when it comes to the PP&E balances? Well, if you listen to what Warren says, his favorite companies are Coke, McDonald's, State Farm, and Wrigley Chewing Gum, okay? Those are some of his favorite investments. Think about why they are his favorite investments. Insurance is insurance. It's paperwork, okay? You don't need a lot of PP&E to operate that. Soda is soda. It will always be soda, okay? You don't need the latest and greatest bottling machines to produce soda. It's essentially reached the end of its technological advancement. So if you look at these companies' PP&E, it's relatively low and stable, okay? That is what Warren loves to see. Low, stable PP&E balances as a percentage of net income. Now listen close, because this is an important point. This is what Warren says, okay? A business that has a consistent product or service will have consistent profits. Again, a business that produces a consistent product or service that doesn't have to change equates to consistent profits. Now, this is one of the reasons why you don't see Warren investing too heavily in capitally intensive industries. Going back to the balance sheet of Apple, moving down it, we're going to look at other non-current assets. And these primarily include goodwill and intangibles. Now, what is goodwill, people ask? It's the excess of the fair value I pay for a company over its book value. For example, I buy a company with an accounting book value of $10 million, but I pay $12 million for it because I think it's really worth that. That difference, that $2 million, we booked to goodwill, okay? And that goes in the balance sheet right here in the other non-current assets section. Now, what does Warren want to see when it comes to the balance of goodwill? What Warren wants to see is an increase in the balance of goodwill over the years. Now, why does Warren want to see goodwill going up? Because that means that the company is expanding and buying out other businesses, okay? That indicates that it's generating enough cash to expand beyond its own core operations. If I am buying businesses, that indicates I have the cash generation capabilities to do so, most of the time. That's what Warren wants to see, expansion coupled with good cash flow. Now, what Warren does not want to see is goodwill remaining flat, okay? Because that indicates that the company is not expanding, which further indicates that the company isn't making a whole lot of money. Remember, the goal of any business is to provide a return for its investors, and you can really only do that by growing through acquisition or mergers. Now, moving on to intangible assets, these are things like copyrights, patents, trademarks, and brand names, okay? Things we can't really physically touch or see. These types of assets are carried at their fair value, okay? And they're amortized over time, okay? So the value of that account, you're gonna see steadily going down over time if the company stops acquiring, okay? It goes up if you acquire other companies' intangibles, and it goes down over time as we're writing off the value, okay? Because these things do have a useful life. It's important to note that under GAAP, a company cannot carry the value of its own internally created intangible on its balance sheet unless it's a trademark or a patent, okay? But there are exceptions to that rule. Generally, you can only really have intangibles on your balance sheet if you acquire it from a third party, okay? Again, this is why Warren wants to see its balance increasing, because it means you have the cash to expend, to buy out competitors, to buy other assets, and to expand your operations. For Apple, we can see, looking at its balance sheet, its intangibles balance is going up, which indicates that it's acquiring and buying other intellectual property. Last up in the assets section is long-term assets. Here in Apple's financials, it calls them non-current marketable securities. Listen closely, because this line, long-term assets, is Warren's second favorite account on a financial statement after cash. Now, what are long-term assets? Okay, long-term assets can be real estate, the value of subsidiaries, affiliates, other types of operations, okay? So these types of long-term holdings, that are usually big and expensive, honestly. You have to understand that if you see a company with a large long-term assets section, that means you're dealing with a pretty generally good company with excellent cash flow, okay? Companies that have the money and cash to buy other companies out, to take stakes in other companies, tend to be very well financially. And what Warren sees and really says is the fact that Apple has over $100 billion in long-term assets alone is probably the greatest source of value the company actually has. Warren also sees that this account is very important for getting inside the mind of top management, okay? What types of companies is management buying, acquiring, or taking stakes in, okay? It allows you to judge their competency and strategic long-term planning capabilities. Now, what are the questions that Warren is asking as he's looking at the long-term section? He's asking what types of companies is the parent company buying, okay? Whose debt are they acquiring? Are they getting involved with good businesses that generate a lot of cash or broke ones, okay? Are they being careful and methodical of the companies they're acquiring or the assets they're expanding? These are the things Warren wants to know. It helps get inside management's mind, and it lets him know if his money is safe and if it's going to grow, okay? Smart management tends to spend their money on buying other assets that will make them even more money, okay? Almost like hedge fund managers. You really want to understand what management's thinking. What's their long-term plan and view for the company? Now, the last metric that Warren utilizes when looking at the assets section is the total return on assets, which is just your net income, which you find in the income statement, divided by your total assets. This ratio gives me the efficiency with which I use my assets, okay? How much money, how much net income am I making off the assets I currently have? A good ratio Warren wants to see is between 10 to 25% of the return of assets. Warren does not want to see overly large returns on assets because that indicates a competitor could come in and steal some of that away from you. Remember that business is a battleground, and if there's money to be made somewhere, competition will move in. That's why balance is critical in all your financial metrics. Apple's ROA percentage is 16%, right exactly where Warren wants to see it, and it's quite a phenomenal number. All right, now we've covered a lot in the last two videos focusing on the assets section of the balance sheet, okay? There's a lot to cover, and I really want you to understand why and what Warren is looking for. So please watch this video a few times, practice with your own company's financials. That way you're gonna understand it with practice, and eventually you're gonna be able to spend a few minutes looking at any company's financials and truly understand what its business is all about, where management is taking it, and if they're even competent. Now, I've given you all the tools to analyze the assets section, just like Warren does, but we still have to cover the liability section next, and we'll do that in a future video, okay? So I hope to see you there.